The stock is trading at only $12.30, down 87% year to date, and at a market cap of $714 million. Further zooming out, the stock is down over 95% from its all-time highs and has been consistently falling since mid-2023 with really no to little relief in the prices. Has been consistently falling. So why has the stock fallen so substantially? Well, here's a graph that shows just the revenue and net income over the past 5 years, and you can see it's growing up until that Q3 2023, and we just see a sudden sharp drop off in revenue and net income just shifting to now a significant loss in the last quarter especially. So effectively, we've seen this sharp turn in fundamentals, and now that's been reflected in the share price as well. Looking at the balance sheet, the company is now in a slight net debt position, including leases, and they do a marketable security, so we included that as well. Compared to their previously large net cash position, at the highest value of their net cash at Q4 2022, the company had $934 million in net cash, and now has a net debt position of only of $23.6 million. Not a massive debt problem in isolation. That'd be fine if we got a profitable company of this size. But when you're looking at these trends and now you're seeing them into debt, it just shows the massive degree of cash burn and the deterioration of their balance sheet, which is the overall concern. So what eviscerated their financials? Well, simply put, for SolarEdge's products, demand collapse. With heightened competition from China and governments implementing policies to push down solar prices in the US, Europe, and really all over the world, overall electricity prices falling in Europe, as well as higher interest rate environment compared to a few years ago, demand was just obliterated for their products. Ultimately, this caused a massive inventory build-up to occur for SolarEdge as they could not sell their products at the price they previously were. The chart I have on screen right now really shows how the company just has grown a significant amount of inventory on its balance sheet once those revenues fell off. You can see it's kind of moving along. That's normal. Revenues grow along with inventory. Sometimes you'll build up inventory in some quarters. Sometimes it'll drop. Depends on the seasonality. Depends on the business. But they're trying to moving in a trend together. But then you just see that massive divergence at that Q3 2023, where inventory just skyrockets compared to as when revenue drops because they're just simply not selling enough product. And if you're wondering that last quarter, why did inventory drop off so well? Well, that's not because they were selling the product. They actually had a massive write-down in their inventories to their net realizable value. And that write-down was $639 million, meaning that the company's inventory's expected revenue is now below the cost of goods. So they have to write it down to that net realizable value. The company is currently actively running promotions as part this is in tandem with those write-downs. They're doing promotions. They're at lower prices in Europe to attempt to regain some sort of market share. This will likely result in a further decrease in revenue and gross profit margins in the next couple of quarters at very least until this inventory is sold. Selling inventory at less of a cost is obviously a very negative thing, but even holding inventory for a prolonged period of time like they are right now does have its own costs. Well, you do have to actually store the inventory somewhere. There's your actual cost, and then you have your opportunity cost of its capital just sitting there. But a couple of things that I want to highlight after the end of the quarter when the company has announced the shutdown of its energy storage division. The division has been running at a significant loss over quite a bit of time now. The company expects to save over $7.5 million run rate by the second half of 2025 once it's all shuttered. The company is now expected to focus on its core solar business lines. Another item is the company now has a new permanent CEO, Shuki Nir. I'm probably saying that wrong. The former chief marketing officer after the prior CEO abruptly stepped down in August, so potentially a change of pace, but not one that was initially planned. So that's not the greatest thing, but it's obviously improvement that they can at least have someone permanently in charge instead of just having an interim CEO. But that's still not the greatest when it's not planned. And don't really expect a sudden turnaround by any means in the near future due to any of that. The European solar market still has weakening demand. The stock to just turn around, the market conditions need to support it, and the company needs to follow through with at very least improving financials. They don't need to be overnight profitable, but they need to at least not be burning cash like they are right now, not this persistent degradation that we've seen over the last couple of years. The balance sheet can really only allow losses for a finite amount of time And now that they're in an overall net debt position, that time is getting lower and lower if they can't have some sort of improved financial. But for now, they get our not so covenant award of being our dog of the week.
You know, it's an unfortunate situation with SolarEdge because they were a company that just had absolute stellar fundamentals at one point in time. And I mean, you saw that huge net cash balance as well. And it just, I think a lot of it just came down to just that the big demand over a period of time for those residential solar projects. And then, that there's just not many people installing them right now.
Yeah, exactly. When all of a sudden, I mean, interest rates, like people are already
Makes
getting
a lot more
squeezed.
expensive. A lot of like some of the issues and counter arguments come out over the years, and it's just it's a big commitment.
And all those different macro events kind of hit within that year period, so it just creates the solar downturn really hasn't just been SolarEdge, but they've just been hit specifically harder than others. I want to highlight that as well.
Board pretty much, but they have been hit disproportionately.